2020 is going to be a big year for crypto. The crypto winter of 2018-2019 flushed out much, but certainly not all, of the nonsense, and the market has significantly matured over the last few years. In 2020, I expect accelerating crypto asset adoption, and key building blocks will come into place for crypto to achieve its long-term potential of revolutionizing how value is stored and transferred around the world. I think my 85 theses from approximately 7 months ago have aged pretty well. Here, I'll focus on the 15 most impactful developments I expect to see in 2020. Institutional investing. The global macro investors come in. Ray Dalio clearly laid out the global macro thesis for crypto when he said, "So, the big question worth pondering at this time is which investments will perform well in a reflationary environment accompanied by large liabilities coming due and with significant internal conflict between capitalists and socialists, as well as external conflicts. It is also a good time to ask what will be the next best currency or storehold of wealth to have when most reserve currency central bankers want to devalue their currencies in a fiat currency system." Ray's conclusion was to buy gold. In 2020, I believe large global macro hedge fund investors, potentially even Ray, will publicly take the position that Bitcoin is a logical asset to hold if you believe this narrative. Traditional asset managers continue to trickle in. I am very encouraged by the State Street survey indicating 94% of their clients hold digital assets or related products, and a survey of endowment funds in which 94% of them stated that they invested in crypto assets over the last year. I expect these types of traditional asset managers to continue to show strong interest in crypto in 2020, but do not expect massive inflows from this segment. The primary reason for this is that portfolio manager incentives are not conducive to encouraging large crypto allocations. Currently, crypto is still a non-consensus investment. If a portfolio manager gets behind investing in crypto, and it does well, they probably get a nice bonus, but not the types of payouts available to those investing their own money or 2/20th hedge funds. However, if it does poorly, or they lose money in an operational issue like an exchange hack, they get fired for losing client funds in magical internet money. The portfolio manager who sticks with the consensus position of not taking a meaningful bet on crypto keeps their cushy job. Eventually, I believe the consensus will shift to the position that crypto has a role to play in a diversified portfolio, but not this year. Retail investing. Bitcoin derivatives trading grows. Altcoin trading shrinks for active retail traders looking for quick gains. Long-tail altcoin trading was once the place to find the volatility and potential they sought. Now, with altcoins down 90% plus from highs, active traders are increasingly moving to leveraged Bitcoin derivatives trading, which offers the volatility they seek, in an asset that is not on its way to zero. I expect volumes on U.S.-regulated crypto derivatives exchanges, e.g., CME, backed to grow strongly, but the center of activity this space will continue to come from exchanges that cater to non-U.S. retail traders, BitMEX and the like. Stats get stacked, and earn interest, while derivatives are great for active traders. The more important developments for those accumulating crypto are those that enable them to easily grow their holdings. In 2020, this will happen in 2 ways. 1. The ability to earn crypto for retail activity will accelerate as more e-commerce and payment companies integrate this into their offerings. And 2. Crypto holdings will increasingly migrate to places where they earn interest, such as BlockFi, Celsius, and Voyager. Ethereum could soon pump 100% to $260, according to analysts. Several analysts have predicted big gains for the number 2 cryptocurrency by market cap, Ethereum, in the next few months. One even suggested a replay of his 100% surge prediction from early last year, in a tweet on January 1. Falling wedges break upside 68% of the time last week. Analyst Manu Naik pointed out that the ETH1 United States dollar day chart was in a falling wedge. These break upside 68% of the time, he said, and $128 is at the lower limit. The falling wedge is still in play. And we are still at the lower limit. This means that Naik's prediction of a potential upwards breakout to $240 by mid-January could still be on the cards. ETH looks better than BTC at the moment. A Wolf of All Streets analyst Scott Melker tweeted on New Year's Eve that he believes Ether looks better than Bitcoin at the moment. He followed that up on January 1 with an ETH-BTC chart, highlighting the range that ETH has traded in against BTC since July. The current situation sees ETH rebounding upwards off significant support, putting it in a great position to go higher.